So good morning, everyone, and thank you very much indeed for the webinar. My name is David Lewis. We've got a pretty packed to get through, but before we start and before I introduce our two speakers, perhaps I could just give one or two brief housekeeping points. So the length of the webinar will take no more than 1 hour. You will get a recording of today's webinar a couple of days afterwards, so if you want to look at it again, then you'll have the opportunity to do so. We would very much welcome your questions during today. You'll see in the bottom right-hand corner of your screen a question box where you question our panel. If we don't get around to all of the questions during today's session, then we will make sure that we respond to them separately as a follow-up to this morning's webinar. So to raise anything that's of interest to you. We will also be sending to you a brief survey at the webinar. I would really encourage you to take a couple of moments to complete it, please. It's very helpful in assisting us to shape future events. So with no further ado, I'd like to briefly introduce our two presenters, Rob Farquharson from Thomas Carroll and Bethan Cousins from the Development Bank of Wales. And Beth, perhaps you'd like to just briefly introduce yourself.
Thank you, David, and good morning, bore da to everybody. I'm Bethan Cousins, the new Business Director at Development Bank of Wales. We work to unlock the potential of Welsh companies by providing sustainable finance to them. And my job is to work with a team of committed people across Wales who love to engage with businesses and find the right funding solution which suits their needs.
Thanks, Beth. And Rob?
Good morning, everybody. Thank you, David. So I head up the trade credit and surety team at Thomas Carroll. We look at putting credit insurance policies and surety bonds into place for our clients and prospective clients, and we'll go into a lot more detail about how credit insurance and funding can work closely together over the next hour or so. But I've recently joined Thomas Carroll, 19 years within the trade credit sector. So I like to think I bring a lot of experience to the to the team, and hopefully we can share our views and opinions with you today, and how we can all work closely together and protect and grow our businesses.
Thanks very much indeed, Rob. So let's kick off with the first question to you, Beth. Obviously, the last 12 months have been let's say, quite exciting for everyone. But from the current perspective, what are the main challenges you're seeing that businesses are facing, both in terms of the current pandemic and, of course, trying to adapt to a post-Brexit era?
Well, as you say, David, it's been extraordinary times, and I think companies across all sectors have experienced some real challenges in the last 12 months. And not to state the obvious, but some sectors have been particularly hard hit with an absolute restriction on the ability to trade, leisure, hospitality, tourism. But actually all businesses suffered a major shock at the start of last year with declined or interrupted trading. So I think it's fair to say that profits and cash availability has suffered as a consequence, with GDP dropping by 25%, at the start of the year. I think the main, there's probably three kind of key impacts that we see with the companies that we work with, and the obvious and major one is constrained working capital. So companies are suffering late payments from customers, stretched cash. They've used a lot of their cash flow reserves to work through that summer period. But also with the advent of Brexit, lots of companies have been holding higher stock balances to be resilient to those dynamics. I think companies have also found difficulties in exporting. So, both from an interrupted ability to travel or work internationally, and obviously now there's a whole new picture emerging with how we're going to engage with Brexit. And I think one of the other overarching concerns for us as a funder is just the level of sort of debt burden that companies have had to take on over the last 12 months in order to be resilient. So, there's over 55,000 bounce back loans in Wales alone, and another 2,000 loans taken out for CBILS, which, has been great actually that there's been the funding there for companies to assist their cash flow. But the key challenge, that we see coming up is all of those things colliding now. So, you know, they will have to start to repay debt, perhaps unwind some of the HMRC holidays, and repair their balance sheet. So all of those things really make it quite difficult to invest in their future growth, even though actually we do feel that confidence is returning. So there is an opportunity over the next 12 months, but the challenge is, you know, how do you fund it, and given the year that we've had.
Thanks, Beth. And Rob, Beth touches on a number of the challenges that the businesses are facing in terms of maintaining trade. How can credit insurance support them in that way?
Well, maybe firstly we should take a slight step back and say what's the fundamentals of a credit insurance policy. You know, yes, it's all very well saying, you know, how can insurance help, but if we don't understand really what the insurance is there for in the first instance, then we don't know how it's going to help. So the insurance policy is there to help you build and help you sustain a resilient business, you know, in guiding you both safely and securely into your existing markets, but as Beth touched on with export, into your new markets and new territories. So credit is there to fundamentally help the business be protected from the unknown, whether that's be, you know, a bad debt, whether it be because a company has gone bust, whether it's from protracted default, which is where a business just doesn't want to pay you for whatever reason. And businesses will come up with so many excuses about why they don't want to pay an invoice. You know, it could be, you know, the person in the credit control department is off sick, or it could be that, or we lost the invoice, or it could be a dispute. It could be any manner of things. So credit is there in the first instance to fundamentally help you and protect you against bad debt. Okay. But also when, you know, Beth was talking about resilience and talking about how, you know, the ability for businesses to grow and prosper, credit is also there to assist in identifying those new markets, identifying those new customers, and giving you the ability, or the underwriter the ability, to check those businesses out before you start trading with them. You know, there was quite a significant statistic from the CBI recently that stated that in the UK, nearly 7 billion was written off in bad debt in SMEs alone back in 2019, early parts of 2020. And one in 5 small businesses had told the insurer that they'd written off bad debts, and 1 in 10 had stated that they had given up receiving an outstanding balance of £100,000 or over. So if a credit insurance policy was implemented as part of a funding package or a standalone policy, that would also assist in the business being protected, but also giving the ability to grow in the knowledge that an underwriter has got their back.
But one of the problems, Rob, though, surely is that is it not true that the insurers are only really interested in covering the sort of the good risks? Is that not the case?
Yeah, of course, yeah. I mean, you go back to 2006, 2007, 2008, when the first crash happened, and the world fell off a cliff, and so did credit insurance. And it was a case of the insurers only want to insure my good risk. You know, I've got a business that's 50-50. And the insurer won't touch them. You know, what's the point in having an insurance policy because of that? So the insurance market had to evolve, and it had to change. So now you're not trying to fit square pegs into round holes. You don't just have to insure all of your customers. You know, you don't just have to insure every single part of your business and your turnover. You can look at single businesses. You can look at part of your debtor book to insure, but underwriters have to now look at the businesses that are 50-50. They can't just look at all of the good businesses. You know, otherwise nobody would credit insure. So there are now more stringent things in place that will allow the underwriter to say, actually, should we be looking at this business? We'll take a more commercial decision. But if we do need to take that credit limit away, what we're not going to do is take it away like that and in an instant. We have to give the business at least 30 days notice of taking that credit limit away. So there are now things in place that have been implemented by the underwriters that will prevent just credit limits being taken away in an instant. So yes, to answer your question, in the past it has been perceived that yes, they will only insure my good debt and not my bad debt, but that has changed and it has evolved. With the government guarantee scheme that's in place, we're hoping this potentially may be extended from the end of June, that it's likely to expire. And if it does carry on, it just means that there's more stability because the government are underwriting or guaranteeing limits that are already in place.
Yeah, thanks, Rob. I suppose my concern would be if sort of credit underwriters are now being forced, if you like, to look at a wide range of different risks. Is that not making credit insurance unaffordable?
No, not at all. Not at all. Of course, there will be a cost associated to an insurance policy, and it's based on sector. It's based on whether the customer has experienced any bad debt and the level of turnover that they want to insure. But let me just give you a very quick pen trick. So here we go. This is a seesaw, and this is your turnover, and this is your premium rate. So the lower the turnover, the higher the premium rate. The higher the turnover, the lower the premium rate. But you've then got other aspects involved in that. So if on this side you've had a lot of bad debt, then of course it's going to make the premium rate go slightly higher. Do you see what I mean? And I would say the past couple of years we've reached a point where the market is at the lowest it's been for a long, long time. Premium rates were very low and credit limit applications were very, very high, and it was unsustainable. So inevitably, yes, premiums are going to rise, but you're not going to see 40, 50, 60% increase in premium values. Yes, you will see maybe increases of 5, 10, maybe even 15% across the board, but that should bring it back to where it possibly should be. But you won't see wholesale increases in premium. But the credit insurance has been perceived as being expensive, but actually, if you look at let's just take an example. You turn over, I don't know, say 10 million as a business, and you're in the pharmaceutical sector, which is quite prevalent at the moment. Then your premium rate is likely to be anything from between 0.1 to 0.2%. And the way that you work that out is you take your 10 million, you times it by the premium rate, and that gets your premium. If, for example, you were in a high-risk sector, where I say high-risk sector is a sector that has been, quite strongly hit by the COVID crisis that is ongoing. You could be in retail, for example. You could be, selling into the high street, or businesses that sell into the high street. Then your premium rate could be a lot higher because of the sector that you're actually in. So you look at sector, turnover, and bad debt.
Okay, that's very interesting. Thank you very much indeed, Rob. Beth, perhaps I can come back to you. When you opened, you mentioned that there are all sorts of different challenges that businesses are being faced with now. How are companies, in your experience, going about mitigating some of those issues?
I mean, I think, as Rob was talking about, really, it's about identifying what those key risks are. Obviously, there are lots of uncertainties at the moment with trading, the economic challenges. So having a sort of a clear plan and really having a good look at the company and identifying where those key risks are, and then trying to build some defences against them. I mean, I think being financially robust over the course of the next 12 months is really important. So again, do you need additional working capital? Do you need additional growth funding? Actually, the ICAEW does an annual and quarterly confidence monitor of how businesses are feeling, and their most recent one does show that that despite the second lockdown, actually companies are returning to confidence. So they do think that profits will return, and even employment in the second half of 2021. So I think the key for those businesses then is, well, how do they set themselves up to take advantage of it? R&D and investment in your business is the one area that people have really cut back on in the last 12 months. But actually, in order to catch up and to be poised for that growth, that does need reinvestment. So it was really interesting yesterday to see the Chancellor announcing the super deduction for capex. So again, an incentive there to encourage companies to invest in themselves. So we are beginning to see that with companies, and obviously we're placed to help fund that if it's required. I think companies are also thinking about what's the right method of funding at the moment. As I also alluded to, there's a limit to how much debt you can take on in any business. So equity funding, it could be a potential solution, which doesn't put as much of a debt burden on the business, perhaps gives you more capacity to repair and recover, with an eye on that growth over the longer term. So a few things there.
Brilliant. Thank you very much indeed. Thanks very much, Beth. Rob, let me come back to you. I mean, from everything we've said, and I think everybody on this webinar will understand this, that growth is going to be so important over the next 12 months or so. But how exactly can the credit insurance market help support that growth? What can you do?
Okay, so let's put it quite simply. Credit insurance protects your invoices. That's the simple part. So it protects you, and it gives you the confidence that you can ship your goods safely and avoid those cash flow challenges that a bad debt may bring. But let's put it. And again, you have to excuse me. I'm one for visuals. So let's put it this way. We have an upturned umbrella here, like this. Okay, and this is the business here. And what the upturned umbrella is it's picking up and it's catching all of the bad debt that potentially falls through the net. Okay, but on the top side here, which is your top umbrella, this is where the credit insurance or the underwriters are protecting any nasties from coming in. So where you talk about growth, it's you may, as a business, want to start exporting into territories that you haven't necessarily looked at in the past. You could be thinking, well, actually, if I've always exported to France or to Germany or to the EU. Those areas are now quite challenging. We now need to move further afield. We now need to move to, say, the UAE. We now need to move to Asia or to the Americas or whatever. But we don't know those businesses. We've been approached by a business to export our goods to somewhere that we don't know, and we've looked on Google, we've done a Google Maps, and we've looked at that business, but the underwriter will be able to give you a up-to-date, real-time information on that business. So before you even start making goods to be manufactured or offering services to a business, the insurance policy or the underwriter will check those businesses out for you, so you're not going to waste a lot of time on a tender process. You're not going to start shipping goods that you're never going to be paid for or get returned. So the credit insurer will help you in identifying those good and bad risks, which means that you can grow your business safely in the knowledge that the underwriter is there to assist you and protect you and pay you a claim in the event of a bad debt experience, being experienced.
That's quite interesting, Rob. Where do underwriters get that information from then? Where do they find it?
A whole array of areas. Let's take Euler Hermes as an example. Okay, so let's take Euler and Atradius are, always say they're the biggest underwriter in the world. If you talk to Atradius, they'll say it's us. If you talk to Euler, they'll say, oh no, it's us. But what they have is they have a network of risk offices. Okay, let's take the UK. EULA have a network of risk offices strategically placed around the UK where they employ risk analysts. And those risk analysts will go out and speak to businesses. You know, they don't speak to businesses that are always having to, the businesses have applied for a credit limit. It could be that a new set of accounts have come out for ABC Limited and they need to check them out so they can grade them. So that's then replicated. I think with EULA, I think the last count was 53 countries around the world. So they have real-time information on the ground, not only in the UK, but in countries dotted around the world. And they grade their businesses from a 1 to a 10, 1 being the worst, 1 being the best, 10 being the worst. They'll also get information from their policyholders. So for example, if you've got an insurance policy and you've got a credit limit against ABC Limited and ABC Limited haven't paid you, then that's flagged as an overdue. So that potentially could have an impact on the rating and the credit limits that are being offered. They use status agencies, they use status reports, they use a whole array of financial information that are available through Companies House and such like, and Company Watch. But mainly it's real-time information from the risk analysts going out and visiting businesses.
That's interesting. I mean, I suppose one of the other questions that that poses, Rob, post-Brexit, businesses are really having to look outside of their traditional markets for business. Are there territories globally where you can't trade into or you would be reluctant to trade into?
We just have to follow the sanctions list. So, you know, I haven't got the sanctions list to hand, but you know, you can't necessarily sell goods into North Korea, for example. There are certain restrictions on political risk, and there will be the sanctions list that you're not able to trade into. But there are some underwriters that will view countries that are lower graded than others. You know, you have the A, B, C, D list or whatever, and they will give you the ability to offer credit into some of the more challenging markets. So Credendo is a great example of said underwriter. So Credendo have always been very good in the more challenging markets because of the network that they have. So Africa, for example, is one of their forte. So if you're looking to export into a country within the African region, then my first port of call would be to speak to the underwriters at Credendo and say, what are your views on that? Mm-hmm. So we have to firstly look at the sanctions list and make sure that that the country that you want to export into isn't on that particular sanctions list, and then look at the grading of the particular country. And then if the traditional markets, i.e. EULA, Atradius, Covas, whatever, can't do it, then we look at some of the more specialist underwriters. And that gives the business more, I suppose, more options in where they want to trade, but more importantly, which underwriters are able to protect them.
Okay, that's very interesting. Thank you very much indeed, Rob. Just before I come back to you, Beth, just a reminder to the audience that we're keen to take questions from you. We have a couple of questions coming through. Don't be shy in posting your questions in the box on the right-hand side, and we'll try and get round to those as we go through. Beth, perhaps I could turn to you now. Obviously from a Development Bank of Wales perspective, you must come across many companies who are considering investment into their business. What sort of tip to a company that's considering investment before it reaches out to funders, and how can the Development Bank of Wales support that process?
Okay, I mean, I think that the key message we'd say is be very clear in your plans. So, you know, before approaching funders, try and set out exactly what funding you need, what purpose is it for? So, you know, is it CapEx? Is it growth funding? Is it more staff going into new markets? So having a clear view on where you want to take your business, and actually what that means in terms of growth. So having a good business plan will do that for you. I think being realistic in the outputs, particularly given the backdrop of where we are currently. So building enough headroom, because there's still a degree of uncertainty as to how this next year will unfold. And it's something we would do anyway. You know, when we do talk to any business about funding, you know, we look at sensitizing it and, you know, doing various cases on the company, because from our perspective, we want to make sure that companies are properly funded. So we'd rather give a larger amount in the right way to provide them with a bit more resilience, and because as we all know, business plans don't always go quite as we expect them to, and this year has been the best example of that I've seen. I mean, how can we help? As I said earlier, we've got a team of individuals based in communities all across Wales. And the best thing that we can do is to actually have a conversation directly with companies quite early on. So we're always happy to do that, to understand the dynamics, understand the challenges, because every business is different. So we're more than happy to engage along with your other funders, like your bank, etc., because we're there to sort of work as part of an overall funding package to a business. We've also got a network of NEDs or advisors, and also are quite well linked into Welsh Government as well. So, you know, it may well be that we've come across a scenario in another company that we've worked with, and our portfolio is expansive. So actually, we're very happy to connect. You know, in Wales, we're a market of small and medium-sized enterprises in the main. It's 95% of our economy. So, you know, there are challenges when you're a small business. You can't necessarily do everything yourself. So reaching out to work in partnership with others can be a really important way of solving those challenges. So I'd say an early conversation, clear planning and thought on and what you're looking to do. And, you know, we've got a range of flexible solutions that we can talk to you about.
Thanks, Beth. You mentioned, I think, there that you very much work as a partnership, presumably with the company's own bankers and so on. What would be the first steps then if a company was looking for advice? Do they come to you first, or go to their bank first, or both at the same time? How does that best work in practice?
Well, actually, you know, companies historically very good relationships with their local banking managers, although that has changed over the last few years in terms of, you know, perhaps not necessarily having somebody local to talk to. A lot of our referrers do come in through banks, which is fantastic. So, you know, we don't act to replace that funding. It's more to be complementary to it, and perhaps to work alongside them and take maybe a higher risk profile than the bank may be prepared to do. So, for example, if there's a lack of security within the business, it might be difficult for the bank to fund, but it's something that we may well be able to take a view on more as a cash flow lender. And that's often a good solution for a bank, because it means that we can come in, fund the growth of the business, and then, you know, we're more than happy to be refinanced out as the company secures that growth and is then able to take on more conventional funding. So we are absolutely about working in partnership. Going back to the equity dynamics, which again is something that lots of companies are not as familiar with. You know, it's always worth exploring that as a funding route, because that really is capital for growth. So, you know, that sees less of your cash flow actually having to leave the business to service debt, and more of it being able to be reinvested. So, you know, we're a patient investor in that sense.
Yeah, that ties in with one of the questions we've had actually, Beth, which is, you know, how does equity investment compare to cash investment? What are the pros and cons?
So I'd say that we're very much aligned with the shareholders when we're an equity investor. So, you know, we will be part of the business, although we're not there to, you know, to obviously run it day to day or be involved in the operational dynamics. But we are there to sort of challenge and look at the growth plan, because the equity funding is there to facilitate growth. So, you know, it really can unlock and accelerate growth. So I think that's our experience. So, you know, we obviously also provide debt funding, but it can take a company longer to grow if it's purely through the means of debt, whereas a significant capital investment in the form of equity can really help you grow quickly.
Very good. Thanks very much indeed, Beth. We're about 15 minutes from the end of this morning's webinar. We've had a number of questions come in. So if you don't mind, I'd like to sort of throw these questions at our two experts today. I have my glasses up to read this, but Rob, the first one's for you. The question is, how do you see insurers dealing with the many businesses that have a nil rating, often due to the sector that they're in? And the examples have been given of aviation. So how do with those sort of markets?
Oh, okay. That's I think that's down to, it's going to come down to dialogue, and it's going to be dialogue between the said business and the underwriter, and knowing how businesses are going to, I suppose, come out of the pandemic. I mean, aviation it's going to be a difficult sector, you know, I believe, but everything has to get better. So I think it's going to be more a case of the underwriters talking to the businesses and not just saying, whereas they did in the past, let's go back to 2008 where the recession hit, there was literally blanket reductions of cover everywhere. You were in the construction, the automotive sector. You know, we left on the Friday and came in on the Monday, and 75% of all of the limits that we had with our businesses in those sectors were gone. That can't happen now. And the dialogue needs to keep going, and the businesses need to talk to the underwriters. And there needs to be slight improvements in accounts, of course, for an underwriter to take that risk ever so slightly. But that's where you then start using your discretionary limit as well to offer some levels of cover. And when we talk about the discretionary limit, it's about where you as a business offer your clients credit up to a set amount based on trading history. Okay, so if you have a decent trading history with that business, you can start implementing your discretionary limit so you can get some elements of cover. Obviously, if you've only got a discretionary of say 10,000 and you need £100,000 of cover, that's not going to help you. But it comes down to dialogue, and it comes down to the economy lifting ever so slightly and the underwriters having more confidence within that sector. So it's a very, very difficult question to answer, I'm afraid, and I'm sorry if I'm a bit woolly, but there isn't a hard or fast answer to that. It's just a case of, look, we need to have discussions. We need to be very transparent in the business talking to the underwriter, and the underwriter understanding where they're going to be within the next 6 months, how are they going to, stay afloat as a business, and just discussing.
Okay, so very much a bespoke conversation by the sound of it, Rob.
Absolutely, and that's where we would come in and help, and it's the same with Beth, and you touched on Beth, and touched on a point that it's very bespoke, the offering and how you talk to businesses. And it goes back to something that we said at the very beginning, where you're trying to fit round pegs into square holes. It's not like that anymore. In effect, every type of policy that we put on is different to the next type of policy that we put on. So we do need to have that dialogue. And again, the funding aspect and the credit insurance aspect will absolutely work hand in hand, but we need to have that dialogue, and we need to identify which underwriter is the best for that particular sector, and just have a discussion.
Yeah, that makes a lot of sense. Thank you, Rob. Beth, the next question is for you, if I may, and it's probably a question that affects a lot of companies. You touched on the fact that in Wales alone, a large number of companies have taken funding from the government in order to get through this COVID period. But now, at the point of growth or wanting to think about growing, how do you fund that growth if you can't afford to take on additional debt? What would your advice be?
I mean, it's a real live challenge. I mean, we've already seen, you know, the British Business Bank and the CBILS make announcement that they're going to extend the term of their debt, which does help in some ways, but actually it's only kicking the can down the road in other respects, because it just means you've got to continue to pay that emergency funding off for years to come. So, I mean, I think I would look at other forms of debt over and other forms of investment over and above debt. So, you know, is it now the right time to get some equity investment into your company? And you know, perhaps take some a longer term view on it. When you asked me earlier about, you know, what are the key differences between debt and equity? Well, you know, debt is always often looking back. It's looking at serviceability. It's looking at how much cash you can, you know, pay out. Whereas equity is about looking forward. So it's about looking at the growth prospects, looking at what you could do with the right kind of investment. So, you know, I think restructuring and re-looking at people's balance sheets is absolutely going to be a key feature. So, you know, making sure that you've got the right setup to go forward. So.
Okay, thanks very much indeed, Beth. Rob, I've got a question for you, if I may. And I think in the very early part of today's webinar, the government guarantees, and will those guarantees be extended? And if so, when would you expect that to be announced?
Hopefully very soon. It's a discussion that's that is ongoing, and it's a discussion that needs to keep being had. Euler Hermes were the real driving force behind the guarantee scheme last year, and it was implemented and extended to the end of June. Now, given the fact that that the furlough scheme has been extended, then I don't understand why the government guarantee scheme wouldn't be extended in line with that. My only concern is that if underwriters have been writing limits or offering limits or keeping limits in place on the back of the government guarantee scheme, potentially, the end of June, early part of July, we could see a real dip in credit limits, and underwriters could turn around and say, well, actually 50% of that limit now isn't guaranteed by the government, so we're going to take 50% away. That's my fear that potentially may happen in June. But let's keep our fingers crossed that it is extended to at least fall in line with the furlough scheme. I think that's extended to the end of September, isn't it? September, October time. So it does make sense for that to be extended in conjunction with that.
So just watch this space. But you're hopeful.
Yeah, I mean there hasn't been any, there hasn't been anything announced. There hasn't been any indication that it's going to be extended. But then when it was supposed to be taken away last March, I think it was literally, there was just something put out on the website so that it's been extended till the end of June. So I wouldn't imagine there'd be a huge discussion. It would just be, oh, it's been extended. So yeah, it's a case of watch this space, but touch wood, it does get extended, because the potential impact on limits could be quite damaging.
Absolutely, yeah, I think that's a very good point indeed. So let's keep our fingers crossed.
Yeah.
Okay, we're coming now to the last few minutes. I'm going to pose the same question to each of you. I'm going to start with Bethan. Bethan, obviously we saw the budget yesterday, and I think we're all hoping that we're now seeing the light at the end of the tunnel as far as the COVID pandemic is concerned. So from your perspective, or from the Development Bank of Wales's perspective, how do you see 2021 developing? Are you optimistic or are you pessimistic?
I think we're very optimistic, actually, because as I said earlier, companies seem to have realised that even though we're still in lockdown, there is light at the end of the tunnel with vaccinations coming on board. We've got a roadmap towards the summer that means we're trying to get a path to easing. I do think there will be a bounce back in growth, so companies will be, looking to drive their businesses forward. So optimistic. We've also had significant new funding. So actually, a year ago, before the pandemic, we looked at supporting about 500 businesses in Wales. This year alone, actually, we've trebled that number during the pandemic. And doubled the volume of it. So actually, we are there to help and support. So our, whole reason for being as an institution is to help the Welsh economy to grow, to help businesses to prosper and develop. So, we are there to invest and to help you through it where we can. So we've had a new £270 million funding from the Welsh Government over the last week, which means we've got the capital there to support businesses. It's flexible funding. It's got a longer term than we've ever had, so we can now invest up to 15-year term money, and we've increased our investment levels up to £10 million in 21 company. And we're also supporting small startups. We've seen actually twice as many startups in our micro business this year as we've ever seen. So actually, people are looking for new routes to be entrepreneurial and find new ways of working in our new world, because I think things are not going to revert back to how they were fully. We are going to have an element of remote working. So I think the world has changed, but hopefully, there's some positive aspects that come out of a new way of working and a reinvigorated growth in the second half of the year. And, we're there to help facilitate it.
That sounds very encouraging, Beth. Thank you. And I know that from looking at the questions, we've got a couple of our audience already who want to connect with you. So I'll be passing those details to you after today. And Rob, same question to you. Are you optimistic or pessimistic?
Oh, I'm very optimistic, and I probably don't need to say much more. I think Bethan's covered has covered all that tremendously. But from a credit insurance perspective, I've been regular dialogue with all of the UK underwriters, because we need to keep abreast of what's going on, how they're doing in terms of credit limit coverage, premiums, are they going to increase? We need to understand all of these, because we need to pass that information onto our clients. And speaking with AIG yesterday, it's a prime example. They've had their busiest quarter ever. Wow. in terms of both new business and renewing of business. And they have said they are well and truly open, and the amount of cover they're writing compared to even this time last year it's incredible. So my only concern is we may have a bit of a dip, and we may see a number of insolvencies that come to the forefront, and that will probably happen end of Q1, Q2. But I see later on in the year the business is really thriving, and I'm really very optimistic. One last statistic: I had a very similar question asked when I was on an Atradius webinar a couple of weeks ago, and they actually had a poll and said, are you optimistic, pessimistic, or staying as the same? 82% of the businesses were optimistic. So to me, that's a really good indication of how we're going to progress later on this year, and how, if we all stick together, we're going to do okay.
I think that's the perfect note on which to close the webinar. And so just a few words from me, just to say thank you to everybody for attending and listening to this morning's webinar. A big thank you to our speakers, Beth Cousins from the Development Bank of Wales and Rob Farquharson from Thomas Carroll. I think the general theme is absolutely one of optimism. There will be some challenges ahead, but it's good to see that we have Beth and Rob ready and raring to go to support you. So please don't hesitate to reach out to either of them, because I know that they'll be only too keen to assist. A brief reminder that a recording of this webinar will be available and will be sent to you in a couple of days' time, as will the survey. We're always looking to find ways of improving these sessions, so if you would take a couple of moments of your time to complete and return that survey to us, we would be extremely grateful. But for now, thank you again to everyone for attending, and I hope you all have a very, very good day. Thank you. Goodbye.
Thank you.
Thank you. Bye.
Bye.